Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Well, it is Non-Farms Friday. I'm still in this place where I'm like, I don't know if this number actually means anything anymore, because every time it comes out, I'm like in disbelief about what we get. But given where the bond market has been and everything else that has been going on, I think that you're going to see a pretty major mover today. And yes, so if we come over to the charts, the big thing that we were looking at yesterday was the treasuries. Were they going to go down for a new low? They were not quite able to make it yesterday. You can see here they spent a lot of time down there at the lows, right? But here in the overnight session, they have eventually breached through there, although nothing too crazy yet. So we're kind of we're below the value if you come to the ZN, right? If this number is like high, the treasuries are certainly in the position to just shoot down there and we could really get a big rise in rates here today, right? Coming over to the S&P 500, well, big earnings yesterday. Amazon was good and they're up big. Apple was not so good. They're not down like super huge, but they are down pretty big for Apple. So that's what's going on over there. Oil, again, it took like a huge dive yesterday for who knows why, and it looks like yesterday they pretty much recovered it all. Here we got gold and silver kind of languishing a little bit because of the interest rates, and copper also struggling here. Is China ever going to come back? I don't know. It continues to be like a back and forth on that. Bitcoin is just like, there is no activity over there, man. Like, in a normal market, I think that Bitcoin would be a lot lower, but because it's unregulated and everything else, it's able to just kind of hold there. And then we got Bitcoin, or sorry, the dollar. The dollar continues to be dominant, sitting up there at 102.3. So that's where we're at. Let's go into the numbers here. So the headline number that we're looking for is non-farm payrolls, 200K jobs with a previous reading of 209. And yes, it's most likely the case that a higher than anticipated number will cause all markets to sell. And they'll probably be fairly correlated. Also, keep an eye on those. Let's see here. Where is it? Okay, the unemployment rate has been at 3.6, and remember, those are two separate numbers. They're not like derived from each other. They come from different surveys, so you got to pay attention to that one. And U.S. average earnings month over month, we're looking for a reading of spot 3, but I do have some concerns that could come in a little hot as well. And so just keep in mind that with all of those numbers, and they could be telling us different things, you might see action kind of both ways. All right. So I'm coming in here. I want to see what some of the different analysts say. They're not giving it that time. Giving it to us this time. Nope. I like to see what the Goldman Sachs analysts are predicting, because they are usually pretty good on this one, but I'm not getting anything. So we got 2 minutes here. 40 is okay here in the micros, but of course they've already pulled in the headlines, so. Morning, Michael. By the way, good morning, Octavius and Mishan. All right, so Ooh, okay. I haven't heard the number yet. Okay, 187. So lower than forecast. Wowzer. And the unemployment rate is better than expected at 3.5. So they're contradicting each other essentially. Wow, that like declined a ton first. What's with that? Wow, I was just about to come in and put my orders in, but then they started moving. That's funny. Yeah, that one was particularly disorganized, wasn't it? Well, I think that maybe the reason why it behaved the way that it did there is that the payrolls has kind of been like beating people's expectations a lot. So for them to be 187 versus 200 is actually like a pretty big change from the trend. Let me see if I can show that to you guys here. And like verify what I'm saying here. So if my memory serves me correct, if I'm recalling things correctly here, yeah. You have been seeing like the headline number declining, but you notice that they're over the estimate, the little golden line. You know, for almost for a long time, they were beating the estimate. Last month, they were like almost right on. but this time they underperformed by a decent 20K. That's a big change. Now, the other one that I wanted to see, average earnings month over month, spot 4%. Yeah, that is not what you want to see. Oh, man. Okay, so this is going to be interesting with the treasuries. This is going to be really interesting because what I'm seeing is, again, a very stagflationary number because the jobs are not growing as much as people thought, but the hourly earnings is going up more than anticipated. So you've kind of got this thing where there's the risk of a wage price spiral happening exactly at the moment that the economy is kind of slowing down. So that is all just really super interesting, if I can just say. Maybe we'll see an adjustment on expectations moving forward. I don't know. So I am turning my account off. I am really not sure how the market's going to react to this. I would think that you would move up. Okay, there was like a big down and then up. So let's get that out first. But that was probably just like, you know, the liquidity pulling and all that sort of things, right? But you know, after moving to that high, we've come back to the break-even level. That's not uncommon, even for a really big and clear number. But there's kind of this thing where, so another thing you got to keep in mind here is that the individual numbers that we got in there contradicted each other, right? So the headline number that everybody pays attention to was a little bit lower than anticipated. But the unemployment was a little bit better than anticipated as well. And the average hourly earnings was a little bit better than anticipated. So it's unclear to me how much the market is going to care about those individual components. I don't think that it's particularly great for the S&P 500, but especially for the treasuries here. It's kind of like, I don't know what's going to happen. That you got stopped out? Well, please don't hold the position going into non-farms payroll unless it's like a YOLO sim / prop firm account or something. Let's see here. What do you see on the DOM to actually enter? I've tough that I could be similar using footprint, but even with seeing strong orders and price moving higher, many businesses maintain it. Oh, and got stopped out. Oh, okay. I misunderstood what you were saying. I'm sorry, Daniel. Okay, so here's how I would approach this. So first of all, I have a video series about order flow, and it's about 5 videos now. Okay, and I would watch all of those videos. There's some important information in all of them, particularly those last ones about stylized behaviors of markets and the inelastic markets hypothesis, which kind of form the basis of our approach. Okay. Now, in terms of like the actual entry, you can't use the footprint for the actual entry part, because when it comes down to when I actually click, what I am seeing on the liquidity matters a lot, right? So if I'm going to buy this right now, let's just say I'll move to my experimentation account and let's just say that I want to buy. I want to buy, oops, I didn't put it in auto mode. Okay. So there was a little bit of an iceberg there at 13, right? Okay. So I kind of if I'm going to buy on the limit, I would prefer to have a lot of limit orders backing me up so that it's less likely to go through me. If I'm going to buy with a market order, I kind of want to catch the edge, right? I kind of want to catch it when there's not a lot of liquidity there, in the hopes, because what I'm trying to do is I'm trying to minimize adverse excursion. If I can get in and immediately have it bid like it is right there, right? Then I always have the option to, I don't like this. I'll just kick out at 03, right? So you can't really do that with the footprint, because what the footprint is telling you is how much volume is traded like in the past, and it doesn't show you the current liquidity. Okay. Now you can add like these DOM things on your charts, but now the other thing that I don't feel that the footprint really gives you an idea of is that the next thing that I'm kind of watching is like, what is the latent liquidity? So I can see how much is trading at each individual price right now, but how much is being offered and bid at each individual price. But I want to see, like, every time we tick up, how much did it take, right? So right now in this market, you're seeing things like 1,500 to 2,000 contracts trading fairly regularly, just not at every price, okay? So what that says to me is that even though the resting liquidity is quite low, and we are seeing a lot of prices where they'll just trade through them very quickly because this is a volatile market, the actual latent liquidity in this location is actually quite high, right? That's why when I came in to take an example trade for you, I decided to err on the long side, because we're below a pretty critical level 05, but the liquidity is handling it pretty okay, right? So I have to watch these current trade columns to see every time it ticks up how many contracts they took out. Okay, 1426 that time, right? Okay, only 637, so they keep skipping over 01/2, right? And as I see those kind of over time, right? So you can't really, when you're looking at a footprint, that just kind of gets all squashed together and aggregated. And there really is not an indicator, quote unquote, that I know of that is really very effective at giving you a clear picture of what the latent liquidity is doing, right? So that's why I would highly recommend you have a DOM up. Then on top of that, the DOM is just the best way to execute, right? I can place orders, I can move them around, I can cancel them, set the stops, all of those things very, very easily. And that's a huge advantage, especially in a fast market, right? I don't get how people do the, enter the orders in any other way or enter them on the chart. I hate that. By latent, do you mean potential? So I wouldn't say potential. So latent means there, but not active. They're kind of hidden. It's like, so, to go into more detail about it, the issue that you have with just watching the resting liquidity is that traders don't want to make their intentions clear to the market. And by putting a limit order out there, you're kind of signaling to the market what you want to do. If I wanted to buy 10,000 contracts and I go and I just put a big, huge 10K bid at 04/2, what are the chances that they're going to come down and get me? Well, some people think that the market tends to go into liquidity or away from liquidity. So it kind of depends on the situation, but that might not get filled. And if it starts going away from you, then you start chasing it. So if I had that 10K and they weren't filling me, and then I moved up, what do you think's going to happen? Yeah, it's going to run away from me, right? So what do? I don't show the whole thing. I turn it into an iceberg, for instance, or I just start executing a little bit at a time. I say, okay, it ticked down. I'm going to do 500, ticked up, ticked back down. I'm going to take another 500, and do that over and over and over again. And so over time, you can see what the latent liquidity ends up being. And then when you look at the volume profile, like the overall end state of what the latent liquidity in that area is shown to you on the volume profile, essentially, right? But what I need to be able to see is what it's doing every tick. So how do you determine the spot where the latent liquidity lies? Okay, so then you have to get back into why is the latent liquidity so important? The reason that the latent liquidity is so important is because that's what leads to these stylized behaviors around the square root law, right? So when I start to see if we're moving up in a trend and I start to see these places where every time that it ticks up or down, it's trading like 3,000 contracts, right? That shows to me that we're kind of starting to create that situation where we're trading a lot of volume there, right? I'm seeing 3,000s, 4,000s, and then all of a sudden, I'm only seeing it trade 50 at a time. Okay, so what happened there? They traded a ton, and now the latent liquidity appears to be less, which means that we're starting to see the square root law come into play, and I might want to think about taking my profits because it's going to hold the instrument back from being able to go up further. So that's why we're watching it, and that's kind of what I'm looking for. So to summarize, there's kind of different, there's like 2 or 3 different levels that you want to be looking at here on the DOM that you won't necessarily see with other tools. The one is, what is the resting liquidity, and do I have an opportunity to take advantage of catching the edge or icebergs in order to possibly get a better entry, right? Then the second level is, what is the latent liquidity, right? And then the high level is going to be, do I have evidence of some sort of a large meta order coming in, right? So I tell you, through this thing, I'm seeing pretty strong buying coming through into the 5-year. So even though I am not super informed on what the correct thing that the market should do based on the economic data that we have, I know what the economic data was, but I'm not 100% sure how they interpret it, right? But I can very clearly see coming into the 5-year some buying flows. And so that's why I decided here on the sim account to try and take along. So that's how I would approach it, right? Now, when you look at footprint charts, here's what people do with footprint charts is they look at the chart and then they try and see patterns in the footprint chart. They say, oh, look, here was a place where between these two prices, the difference between what traded on the bid and what traded on the offer, there was like a huge imbalance between those, right? Or here was a unfinished auction down here. Like they traded down there, but they didn't hit down into the next bid. It went offer, but it didn't hit into the bid, and then it came back up. Unfinished auction. Maybe we're going to come back down to that. Like those are the things that they teach you with footprints, and I have never been able to find any evidence that those setups, those things that they talk about with the footprint are actually true, that they explain persistent behaviors in the market that can provide you an edge or anything like that. Right. Well, if you see a big iceberg, but the way that they usually approach it is like, there's this imbalance and you take a trade and because it's going to go this other way or something. Right? Because yeah, you seeing an iceberg on there could be great for you to exit if it's kind of in your spot. You're seeing that square root law come into play. Yeah, sure. But you see that on the DOM better. See that on the DOM better, to be honest with you. But basically what I'm trying to say is that I would be cautious with footprint charts, because what they do is they tempt you into trying to perform technical analysis. Yeah, the way that you have your footprint set up is really weird, Kevin. I don't know if I could do that one. Well, I don't know if the latent liquidity is really having a problem, but the volatility has certainly slowed down, and we're starting to just trade back and forth across to 07 half. Oh, sure, you can add those, but why add those? What is the value that the other thing is giving you, right? Dude, my mind is so weird sometimes. I went tonight. I wanted to get some better supplies for when I'm writing things down, so I went and I found like these pens that were like the most permanent ink that I could find, you know? And now all I can think about is when those come in and the couple of things I want to write. But, you know, like, it's so, I'm going to show you, I didn't show them the picture that Kevin is showing me to see what he's talking about. So he's got this sort of a thing. So I think that this, you know, number X number thing is like your traditional footprint. And I don't know what this thing is. That must be the total volume that traded there. And then this one off to the side must be the delta difference, right? I'm just trying to guess based on the thing, right? But like what I'm saying is, okay, what value does this knowing that the delta difference was negative or positive at this point really give you? Right? Because what people will do is they will say, oh, here was a huge delta difference that was super negative. That means I should go long or short or whatever the deal is, right? Okay. Like this. So what will often happen here would be like, oh, okay, like tons of volume traded here. Maybe I need to go long here, right? That's what they're thinking. Is it a 2K iceberg across like all of them? Wait, what is the time frame that you've got on this? It must be a relatively, if this is ZN, it must be a relatively small time frame. Nah, it can't be ZN. It's ES. Gotcha. But like this comes back into these other things, which is, I mean, so I can see that on the DOM, right? In fact, I feel like I can kind of see it better and track it better on the DOM than I can on this. But, you know, if I see an iceberg down at the lows, that doesn't necessarily make me want to buy. Like an iceberg in and of itself is not really tell you a whole lot. I guess you can, but sure. Yeah, it depends on context. But like what it comes down to is you only have so much screen real estate, right? So like, I know I need the DOM. I have another tool that shows me the same things as a DOM. Why am I going to give it screen real estate? You know what I mean? You want to sit, there's sometimes where I do. But usually if I see the iceberg, I just avoid the whole area, right? Well, this one's working out so well, I'm kind of sitting here like, should have taken it live. Should have. No, I don't think that I would have felt very comfortable taking it live. It was a good, what? 2 basis points. Yeah, that's my takeout. So in those cases, if there's an iceberg, I usually stay out or get out. Yeah. If I see evidence of an iceberg pushing one way, which is what I'm seeing right now, then I'm totally great. Okay. But like we're in like scattered action and I see an iceberg, because it used to be that I would see an iceberg and I'd go for it every time, right? Yeah. Well, yeah, I guess you can see that on the footprint, but what the kind of the question though is, if you're new, right? If you're new and you're trying to figure out what you should pay attention to, right? What I would recommend is you have your DOMs up and you pay attention to the DOM and forget about all of these other kind of fancy chart tools, because those aren't going to do as good of a job at teaching you what is going on and being able to see it and read it. For sure, as a beginner, I agree. Yeah. And, you know, if you have limited screen real estate, so for sure you could have one of those up there on like a chart and maybe on a separate tab or something, so that if you want to be able to refer back to it at some point, you can. Yeah, but I wouldn't give it like prime real estate or something like that, right? Yeah, too much information harms rather than helps. Anyways, so if you're still with us here, Daniel, you're right. Here's the bigger thing. That here's kind of like the key hint I can give you that will make trading easier for you. That will turn you from, you know, struggling and basically getting screwed over, but like most people. The difference between that and like actually standing a chance and actually understanding what's going on, okay, is that you need to understand that the market is extremely competitive and that orders have a strong impact on prices, which means that any kind of like statistical behavior that you might see in an instrument, people pick up on it, start to trade it, and because their orders have such a strong impact, they remove those behaviors from the market very, very easily. And so what you're left with is something that is almost indiscernible from statistical noise. It's not actually noise, but, you know, especially when you're just looking at price, it looks like noise, right? The market is extremely statistically efficient, right? But there's a second kind of consequence of all of that, and that is that it ends up being very fundamentally inefficient, informationally inefficient. So people used to think that, okay, this non-farms number comes out, and of course there's all of this shuffling around and all of that sort of stuff, but eventually everybody decides, based on the information that they have, what the correct price for that asset is, and then they trade it towards that direction, and then it will move to that direction and then settle at that point. That's what people thought, right? I mean, that's what most retail traders think, okay? But the research that we have says that's not what happens at all. What happens is the news event comes out, people decide that they're going to buy or sell, and how much they're going to buy or sell, and the amount that they decide to buy or sell determines where it goes. And so you could have a situation where, because there's not enough people looking to trade it and they don't have enough orders, it doesn't come anywhere close to going up to where it needs to. Like maybe fundamental value is actually like all the way up at 111 evens now, but we're not there right now, right? The volume's just not doing it, right? Or it could be the complete opposite. It could be that like that news meant nothing, and fundamental value is where we started at 110.050. But because the orders were there, we're buying it, it moves it. Regardless of what the fundamental value is, the orders still have impact. And by the way, you don't know, those orders can be anything. Those orders could be people like me saying, well, I think that number is a little weak, and so that should take the edge off treasuries a little bit. Yeah. But some of them could also be like rebalancing for the day, like or for the weekend or something. Like some of these orders might have absolutely nothing to do with the non-farms payroll number at all, right? So the informational inefficiency is like everywhere. And what you can do is you can kind of look at these things. So sometimes you will see an informational inefficiency that is just incredibly obvious to you. You'll see everybody talking about it too. To be like, the market is overbought, for instance. Like right now, I think it would be fair to say that the S&P 500 is probably overbought. And I think that the soft landing case has kind of been overbought by the market. I don't think it's over yet. I don't think we're past some of the critical points. I think that there's still a couple of headwinds ahead of us. Maybe prices should be a little bit lower, right? Okay, problem though. That's not what the orders are right now, right? The orders have been buy because of various reasons, a lot of it being short covering, for instance, right? So there's that informational inefficiency there, and it persists for a long time. When do you actually trade it? Well, you can just kind of wait for a moment in time when you have information that says that those orders are going to come, that they're going to come in and sell it because it's overbought or whatever the deal is. And like a certain piece of news comes along or a certain economic number happens, right? And then you have that thing that says, okay, there's an informational inefficiency. I'm starting to see the flows trade on it. I can catch that ride and just run and just let it run, right? Oh, Lucas, thank you for the donation. I've been getting so many donations lately, guys, and I appreciate it so much. Like, even if it's just $1, just the fact that because the money doesn't really mean anything to me, but the fact that you guys are willing to donate just means so much to me. What treasuries do you think are the most important to watch? Also, in your opinion, do they have an inverse-ish relationship with major indexes? Okay. Yeah, I love your order flow and fun. Yeah, thank you. Well, I'm kind of standing on the shoulders of giants here, right? Because what happened is there's a lot of guys that, they just started out as retail traders and they're just trying to pull out the best stuff that they can. Like, I think Futures Trader 71 is a really good example. Like, the amount that he has contributed to the futures trading community is tremendous. Because without that information, I don't think that many traders would really know how to like manage positions and risk very well, right? But he's not like a quant researcher, right? And all I've done is I've taken the information from the quant research side that's been going on for 30 years that retail traders just kind of ignored because they didn't know where to look. They didn't realize that it was important. Maybe they didn't understand it, right? And then on top of that, in the past like 5 to 10 years, some of these guys like Jean-Philippe Bouchot have made like really significant strides in our understanding about market microstructure and order flow. And so all I'm doing is relating that information to you. And I just happen to be the first one to do it because I don't know, because I like complicated things, I guess. Okay, but to the question, what are the most important treasuries to watch? Well, so I watch the 5, the 10, and the 30. Okay. The most important one to watch is the 10 because it has the most liquidity. If TN got to the point where it had more liquidity than ZN, then I would want to watch TN, right? The more liquidity that there is, the more like the more persistent order flows that you're going to see. So like something like there's end of month rebalancing, right? Those sorts of effects are going to be more common and stronger in a really liquid instrument. So a liquid instrument is actually more fertile ground to try and find predictive edges. Okay. So that's why we want to trade or look at the very least, ZN. Okay. Now, the reason that I have the other ones up there is just because I want to get an idea of what's going on other parts of the curve, right? So seeing the very, very long end of the curve and then seeing kind of more of the short end of the curve. But, you know, I could totally see somebody saying, I don't really like the 5-year. I would rather have ZT up here. That would be reasonable, right? But basically, I'm just trying, I just want to have the different sections of the curve up there so that I can kind of see if there are differences between them, right? Like right now, I can see that the 5-year is moving up much more strongly than the 10-year is. So even as interest rates are coming down here, we're getting some pretty significant steepening in the curve from what I can see, right? So that's an important thing to know. But sometimes it's more subtle. Sometimes it's just I can see that there's a lot of buying activity over here, and over here in the 30-year kind of seems like they're selling. So even though I'm not seeing an actual change in the spread, I can kind of see that the flows are kind of moving in a certain way with the spread. Okay, so that's why I have multiple ones up there. But if you're like trading ES, let's say that you're primarily a index futures trader, and instead of having the 30, 10, and 5-year treasury futures up here, you're already spending a lot of screen reset real estate with S&P 500, NASDAQ, and Dow and Russell. And you have all of those up, right? But I want to see the bonds because I know that the bonds can be important, right? Then I would recommend putting the 10-year up. Or that's what I would do, is I would be putting up the 10-year because that's the one with the most volume and liquidity and everything, right? Okay. Now, are they in an inverse relationship? So traditionally, yes, but in practice, no. At least in the markets that I've been in, they tend to be positively correlated more than negatively correlated, because the market that we live in today is driven so much by how much liquidity the Federal Reserve is injecting into the market, how much money the Federal Reserve is injecting into the economy, right? And so if interest rates are going to be higher, that's less money they can put into the market. And so that means, okay, interest rates higher, prices in treasuries tend to go down, right? But it also means less money out there, so equities also tend to go down, right? Because normally what it would be is, the economy is doing really, really well, so they're going to raise interest rates and sell treasuries, and then you get equities up, treasuries down. But because they care about the liquidity, it's there's going to be more liquidity, so that's treasuries down and equities down, right? So you kind of have to identify what is the driving macro factors in the environment at that time to determine whether or not equities and treasuries should be positively or negatively correlated. And of course, the thing that you would want to be doing, Lucas, is, I can see that treasuries are buying right now and equities are buying right now, right? So what does that tell us? Well, I think that the conclusion the market seems to be making for the time being is that somewhat weak headline employment number means there's less pressure on the Federal Reserve to increase interest rates. And as a result, monetary conditions can be a little bit more loose. And so that means that lower interest rates, treasuries higher, equities higher. And that's why they're moving, right? So because I can see what the correlation is, that can give me a clue as to what is actually driving the flows. Like, why are people actually submitting orders in there right now, right? Well, we had a piece of news. What was it about that piece of news that's causing the certain correlations that I'm seeing, right? You've been trading the S&P without paying attention to treasuries? Yeah, I bet you, at the most recent past you probably would. I would still recommend having the treasuries up there, but I don't know if it's a huge help to the equity trading at the moment. Because the way that the equity trading at the moment has been is you just buy it and, you know. Oh, what tickers are the 5, the 10, and the 30? Okay, so the 30 is ZB. So they all start with Z, right? The 30 is ZB. B is for bond. Okay. What we call the 10-year is ZN. N is for note. And then the 5-year is ZF. F is for 5. Right. And then if you want to look at the 2-year, that's ZT for 2. But then it gets weird because like the newer ones are like, so the 10-year is actually not a 10-year. The maturities that they stick in there are actually more of a duration of like 7 years. So they went and they made another one called TN, which is the ultra 10-year, where the contracts, or sorry, the actual cash treasuries that are included in the contract are really actually like 10 years, right? But I guess they had already run out of the Z combinations, so that one's TN. And then there's the Ultra 30 as well. So the Ultra 30 is like really is like pure 30-year notes. Okay. So they call that the Ultra bond. So that's UB. But I don't watch that one as much because it's not very much liquidity and it's very volatile. So I prefer to see the 30-year. I feel that the 30-year is a little bit easier to keep track of. Find having NASDAQ and Dow are far more. Yeah, well, that's certainly true. That's I mean, that's you know, you're bringing up a good point, Kevin, because I think that a lot of retail traders that are trying to trade the equity indexes just pull up ES. Like, not to criticize. I'm not trying to pick on people, but like Matt, he day trades by Matt. He usually has like a chart of the S&P 5 because he's trading price action, right? Chart of the S&P 500 and the S&P 500 DOM, and he's not watching the other instruments. I mean, you're missing out on a lot of information. Okay, do you care at all what the VIX and yeah, oh, absolutely. Not just the VIX, but what the move index, that's like the volatility for the bond market, right? That's the volatility measure for the treasury market. Those are very, very, very important. But the problem with volatility is that most of us futures traders are not getting live data for that. So the way that I handle volatility is, you know, I'll come over to these charts here and I have an indicator that's part of my indicator package that is called multi-ATR. ATR stands for average true range. So these yellow bars are the range of that day, and the white line is the average. And you can change, my multi-ATR allows you to change the unit. So I can show it as ticks, or in terms of price, or in terms of percentage. So what you're showing here is ticks. So right now, on the average day, the treasuries are moving about 50 ticks. At least I think that's what they're doing. I think I have it on ticks. Yeah, it wouldn't make sense otherwise. But when I see 50, I'm like, that's a lot. But actually, that is what it's doing. Yeah, it's ticks. But you can change it like for the ES. Then I come over here. I want to see it in terms of percentage, right? So right now, we're on average trading a little bit less than 1% a day. Are you able to give a month? So it gives you a 2-week trial. It gives you 2 weeks. So if you go to my website and you download the indicator package and install it, it will work for 2 weeks. And if you're doing something I mean, I can always kind of work with you, because when you buy the license, I have to come in and like manually change it. Ooh, which reminds me, somebody sent one in yesterday, and I need to take care of it. Although I don't think that they put in their ID, so I'm gonna have to mail them and explain to them how it works. By the way, they're filling out a decent amount of volume up in here. Oh, there it is. Maybe PayPal just changed the thing. So let's see if we can find him. Here you are. Oh, geez. I'm looking back through my emails and I'm like, oh, I've actually spoken to a lot of people lately. There we go. Okay. There are many new prop firms coming up this year. Do you think we're going to reach a point where only the big guys will be alive, or do we end with like 30 to 40 of these firms? That's I wish I knew, because I really thought that the prop firms would have a harder time than they are. Which is to say, I thought that the main reason that people were trading with the prop firms was because they just didn't have enough money to trade their own account, and the prop firm allowed them to get in for like $100, $150 a month. That was better than trying to save up $5,000 for it. And now that they had micro futures like micro ES, that would, make it a lot cheaper for people to be able to start an account. And so they would have no need for the prop firms, right? But that hasn't been the case, really, has it? It seems to me that the prop firms are just as popular as they ever were, and that I don't really see a strong, outside of course, our community, I don't really see a strong movement in the community towards trading your own account. It seems like that the allure of being funded and the amount that you can make from it, thinking that you'll be able to turn it into a living, just attracts people, right? I can only speak for me as a German, but because of the tax changes, so can you explain those tax rules? So I would, what I would expect to see for the taxes is if you're day trading and it's your own money, that you would have to pay the regular income rate, which in Germany is probably, upwards of 60% or something, but yeah, index options and futures in the United States have big time tax advantages, yes. In short, you have like a loss limit you can only use in taxes. So you're saying that if you trade your own account, you can't count your losses or something? I tell you, like with the way that the futures are set up, like it really is actually very advantageous for you for taxes, because if you make money, like Lucas says there, it's 60-40 split between long-term gains versus ordinary income. So basically, you pay less taxes than if you were trading stocks. Okay, and then if you lose money, you can count those as losses on your taxes. So you get refund because of your losses. So you win either way. Like if you have excessive capital, I think it makes sense to trade futures, and even if you lose a little bit. But I mean, it would be you'd still be better off to have the money, but especially if you're like, middle class and you're just kind of barely on the edge of being able to itemize your deductions. And if you're able to itemize your deductions, then there's all of these other things that you can add on there. Yeah. You can only count losses up to 10K. And they count, let's say, $100 win and $100 loss, which would be break even as $100 loss. But you can make a file as a day trader and specifically make mark-to-market election, and wash sales goes away. Yeah. Oh, well, yeah, that's sorry. I lost track of who was talking there. Yeah, Lucas Walton, you understand that a lot better than most people do. I think the wash trade rule is so dumb. Because like the people that are out there that would actually be doing that sort of a thing, like selling an asset just so that they can count it as a loss on their taxes and then switching around to something else, right? They do it anyways. They just buy something that's a substitute asset, but then they say, no, this is different enough that it's not a substitute asset. They do it anyways. So I feel like that the rule doesn't do anything. So here in Germany, they basically killed the trading with your own money? Maybe after the stream you can send me like the specific rule names and stuff. I don't know. It'd be really hard for me to do research in Germany without speaking German, huh? But is it that hard to make your own LLC? That's another thing. Because over here in the US, if you're really making money from day trading, then there's other things that you can do to kind of reduce your taxes, kind of similar, right? Like you can turn it into an LLC, and you can say that all of the profits that you're making are profits to the LLC, and then you just get paid income, or you don't get paid income at all. It just stays in the LLC. If you have the capital. Yeah, but can't you claim up to like 10K in losses? Oh, Lucas said it was 3K. Right? Well, if you're losing more than 3K a year, then yeah, then it would help. But hopefully you're not losing more than 3K a year. I shouldn't say that. There probably are tons of people that are losing more than 3K a year. To me, losing $1,000 from trading is like feels really crushing to me, even though it's not really a significant thing in the larger picture of things, but it still just distresses me. And to see some people that come in and like, you know, lose tens of thousands of dollars from trading is just like mind-blowing, man. Well, yeah, they count each trade individually. Well, that's what Lucas was saying with the wash sale rule. So the way that it works in the United States, and it sounds like what they've got in Germany is very similar, right? Is that if you buy something, you have to, if you sell something rather. Let's say that you lose $3,000 on something, right? But then you immediately turn around and buy it again and make all your money back. You will still have the $3,000 gain on your taxes because you won't be able to count the sell because it's a wash sell essentially, right? So for a day trader that's coming in and buying and selling the same asset every day, they're not going to be able to count any of their losses, right? Unless you file as a market maker, just like what you were saying. And then you can basically just say, here was like my overall profit and loss and pay the tax on that. But in order to do the market, to designate yourself as a market maker or whatever the deal is, you have to do that ahead of time. I've always wondered, though, if you're trading SPX options daily, but you're trading 0 day to expiration, do those count as... I think that when you're trading derivatives, the rules, you know, it's a different set of rules, right? Thank you. I appreciate that you guys appreciate it. I tell you what, this trade that I've got sitting over here, I'm quite surprised how well it did. Because remember when this came in and this moved, I was kind of like, I don't know what this is going to do. I mean, because I felt like the knee-jerk reaction was Treasuries higher, rates lower. But, you know, I was really unsure about it. Really seemed like kind of fuzzy. So for it to have run and basically gone half a handle so far is pretty impressive to me. Especially when I didn't really get... Oh, actually, I got a pretty okay price because I took it at the open. My CPA scolds me like her child every time I have a wash sale. I don't know, it's just... Oh yeah, I'll read it. I'll read it later. I'll use translate and it'll tell me. Oh geez, 5-3C. That's not good. You use... No, I use Rhythmic. Haven't we been over this before? Live action. I use Rhythmic and that allows me to see all of the prices. There's currently a lawsuit running and hopefully it gets changed. Well, something really needs to change overall, right? Like it's so ridiculous to me that you come in and you're day trading and there's all of these crazy rules and stuff, and then you go over and you do cryptocurrency and it's just like you can do whatever you want, right? Like the whole decent meta order, I guess. I do wonder. So let's see here. When we started this, we were negative 30,000 and now we're positive 1,600. So this has literally been a plus 31,000 contracts. So I'm wondering if what is actually happening is all of these guys like who was it that 2 days ago came out and said that they were short treasuries and whatnot? You're right, like maybe a bunch of these hedge funds were puking there. Oh, I got my fill, $500. I'm okay with that. I mean, it could go a little bit further, but I for me to get more than 16 ticks would be like, whew. I'm not necessarily going to go for that today. Are you guys ready for the open? Oh yeah, this is 5 seconds, huh? Well, this is going to be really interesting. I must say, the S&P 500 being up 20 points from the non-farms numbers seems a little, like an underreaction on their part, Well, what I find odd, Kevin, is that's the first time I've ever heard about this. Maybe trading is just not that popular in Germany. I don't know. I mean, you've been around for a long time, and you've never heard you talk about this. So I don't know. But then at that point, wouldn't it make sense to be using a prop firm that is like geared towards German? Like, I don't know. There sure are a lot of prop firms, man. There's like 7 or 8 now at this point. But that's like the other thing that I think is really kind of weird is that they all, because I talk to these guys. They almost all of them come when they start out, they come and they want to message and talk to me for whatever reason. And they all have the thing that like they think is going to set them apart from the competition. But it always seems to me like they're just kind of, just slightly modifying the rules. I don't feel like that they're doing the prop firm, that they're really making a fundamental that really changes like the problem that we have with them, right? Maybe you did mention that. Yeah, I don't know. Oh, Dennis here is telling me something. In the Netherlands, we don't pay personal income tax on capital gains. We do have a wealth tax, however. Oh, right. But so Netherlands wealth tax. So this comes back to this other thing where like, okay, yeah. Every time that people say they have that country X has a wealth tax, I go and I look at it and it's like they don't actually have a wealth tax, but they have something that's kind of like a wealth. So Netherlands has no tax on wealth, but they do have a tax on fixed return on wealth. Okay. The only thing that I really cared about was that they really pay out. Yeah. I mean, again, the big issue that I have with them is that the funding requirements encourage people to do risky trades. And I think that there's a lot of people that would probably build up reasonable consistency, trading their own account and just being really conservative, but they keep blowing accounts because they're trying to trade to pass the combines. Right? Yeah, and then the trailing drawdown is really like, ugh. Come to Iran or taxes inflation. Are you really in Iran? I did not know that. Oh, they moved another little step higher. Like, is this not backing off? I am really surprised. I thought that did they really allow that kind of stuff in like trading and stuff in Iran? I would have thought that that sort of thing would be, let's just say, like really difficult to do. Because I thought that like the internet was pretty locked down. And for sure. Well, look at it. Trailing drawdown on open positions is so stupid. The only way to beat that is scalping for a few ticks per trade. Yeah. Well. Yeah, man. That's so this little run here, like it's going through, is now turning into like quite the. I mean, you aren't forced to. Well, okay. So if you want to meet the funding requirements within a month, I believe that that's trading relatively risky. Like let me put it this way. So the result is like so what I would say is, like, what would be reasonable is to not have more than a 1% loss per day. I know that probably sounds like super like conservative, okay, but if they're giving you, like, the drawdown is $3,000, right? Well, I know that they're a little different, but let's just say $3,000 to have like an even number, right? The drawdown is $3,000. That basically means that it's basically like a $3,000 account, right? So to make $3,000, you're basically doubling your account in a month, right? And I'm saying that if you have $3,000, that like you don't want to lose more than like $30 a day. Right, so if you're going to lose $30 a day or make $30 a day, okay, how are you going to get to that 3K making or losing $30 a day? It's going to take you forever, right? Right? And of course, they don't force you to do it in a month, but you have to continue paying every month. And And if you actually use like what I believe to be reasonable risk controls for futures, it's going to take you like more than a year to get it funded, right? And in the meantime, what are the chances that you have enough of a drawdown that... Well, I guess if you're trading that, then you're not going to hit the drawdown. But you know what I mean? Like, it's just not. So now, the 1%, that will sound kind of a little excessive, right? But here's the thing. So the typical rule that I always hear retail traders relate to each other is you don't want to lose more than 1% on a trade. So you go through and you decide, how many contracts am I going to trade? And what is 1% of my account? And that's like my max gain or loss for an individual trade, right? So that's where you come in and you're like, okay, so I'm going to trade one MES contract and I'm going to let it go. You know, I want to make $30 or lose $30 if I'm doing equal risk reward, that sort of a thing, right? Totally reasonable with micro ES contracts, right? Okay. Well, there was this one prop firm, and this one was a Forex trading prop firm, but I do think that the numbers that they're giving us pretty true to trading overall. And they said that the vast majority of the people that get funded lose the account. But of the people that like kept the account and had been trading for a long time, that almost all of them kept their daily losses to less than 1%. Right? So when you think about that, right? If you really want to like day trade for a living and you really want to like give yourself the best chance of that happening and being consistent with it, then really you need like a huge account to start with, right? Okay, well, ZN kind of backed off a little bit there. I'm wondering if I come back to the volume profile. Okay. So I was kind of wondering, like, how reasonable of a move is this? Well, they're not above yesterday's high yet. They just barely got to yesterday's high and kind of stopped. So... and I suppose that even 11107 half wouldn't be crazy. So I guess the degree of the move is not as zany as I thought. Although the net change in contracts, I say, definitely is. I mean, we are now to 45,000 net contracts. That's... There's when that news came out and I was like, I'm not quite sure what to do with this, right? I was thinking, well, if we do get a move and I'm not 100% sure what it's going to be, it's going to be maybe like another 10,000-15,000 change. So like, this is I don't know. Let's come over to Zero Hedge and stuff and read here a little bit. Yeah, so can I say just one other thing about the prop firms, and then I kind of want to move on for a little bit and read some articles. But the thing that bothers me about the combines the most is that I think the firms should be giving you more resources. Like what I would like to see is if I'm doing the combine or I have a funded account, they're also giving me a news squawk. They're also giving me research reports. Like they should be enhancing my edge. You know what I mean? Like to me, the advantage of being in a firm, the advantage of kind of being more of a professional is you have more resources, more information to be able to trade off of effectively, right? And they don't do that, right? They don't do that at all. They give you a count and then you're on your own. But I have not really ever seen one where they really give me like strong tools, because from my perspective, it's like, okay, I have financial juice. I think financial juice is like the best thing you can spend money on to try and improve your edge in futures trading. Okay. Having a news squawk is great. And they're $100 a month, or they have like a lifetime license. It's about $1,000 or something like that. Okay. And I just don't see how you day trade without that. Okay. But there's other things that I don't have access to. Maybe soon I'll switch to the pro subscription from Zero Hedge, which is like $100 a month, because then I can read like those professional research reports and stuff. But I don't see any of these platforms giving you that kind of information, or the sort of thing, like something that I would like to be able to do, but I just frankly don't have the time, is to be able to come in for you guys and say, okay, here this morning, here are the flows that we know about, and be able to do all of this quant work to try and estimate those flows and give you guys some idea of what kind of a bias you might want to have coming into the day. And how, numbers, so that you can kind of judge what our predictions were to what's actually happening in the market, like really do what we're talking about, like really professionally, that would be awesome. But it would require time on my part to write the reports, and it would also require probably some proprietary data and stuff to be able to get more data on what the flows actually are, so like that's the sort of a thing that you can really only do as part of an institution, right? So like being in a prop firm, should be a way to be able to get access to those sorts of things, but that's not how they work at all. So that kind of bothers me. Is that they aren't truly doing the thing that would be the most beneficial for the retail trader. But whatever. You're right. They're giving what the industry is asking for. You just want to get paid. Okay. I don't just want to get paid. I want to know more. I want to go further. I want to be, I don't necessarily care if I'm making or losing money if I'm becoming a better trader. The only reason that the making money is important is because that's showing how good of a trader you are. Which, when you take that kind of approach, it kind of shows why I'm as risk adverse as I am, right? If I really, like in this situation, because this is a situation where really as a retail trader is kind of advantageous for us, right? On this kind of a non-farms, it's a little iffy at the beginning. You can make the call what the flows are going to be and just write it. And, we probably could have made the... well, it was like I think that at one point it was at 16, so maybe we could have traded 16 and have made $40, right? That would have been a great trade. But in that situation, I wasn't sure. I felt like I did not know what was going to happen in that situation well enough to really want to make a call. And so if I don't have the edge, then okay, I guess we're not trading this one. But it's only like that because, I want to be, it's all about being a good trader. So what is the best trader going to do? They're only going to trade if they have an edge. They're not going to gamble. They're not going to, they run for profitable. I I think that they really truly do believe that what they're doing is a benefit to the community, though. Like, that's the thing. Like, top step got started definitely as, there was a problem in the community. Most people couldn't trade. They provided a way for people to trade. That's how it started, right? And then what happened was, that did so well, and so all of these people saw the opportunity and decided to start copying it, right? So there's a couple of them that it was some rich guy saw, hey, we can make a business like this, and they just put the money up and created it, right? I don't want to speak to I don't want to bash on specific services, but yeah. But then there's other people. I think the most recent one that I spoke to, I think, was like Blue Sky Capital or something like that, right? They genuinely think, they're traders. They want to help traders. They're genuinely, but it's just like, yeah, well, you've never heard of them because they're like brand new, right? But, that's just where I'm like, well, I mean, if you really want to make things better, I think you have to make more changes to the model, right? I think that what you would, I think something that would be better would be, well, I don't know if it would make more money, but I think that would be better for the community. And then you could kind of work out how much money it makes and where you can kind of fiddle with things to make it a reasonable business. But I would prefer to be running kind of like a combination broker and funded trader program, if that makes sense. So I would say you pay me $150 a month and I give you an account, right? And I'm watching all of the accounts of all traders. And because it's not just like a combine, because my intention is that you pay me $150 a month and you always stay in here, right? That I can see your performance over a long period of time. And I don't encourage you to take these huge swings or anything, right? And so then what I can do is I can give some people just small, tiny accounts and small, tiny risk limits that, if they make a little bit or they lose a little bit, it doesn't necessarily matter because I can make money on the commissions for it. And then for the people that really have a solid track record, then I can allocate the money to them. And I can even come in each day and say, okay, based on what we have going on today, here's how I'm going to allocate the money, And so that way I could turn it into, instead of having this big lofty goal that they have to hit and you take all of the risks to go and hit that, I'm trying to create a system that incentivizes the traders to be consistent, right? That I want to create a system where those guys that come in every day for years and years and years, and maybe they're only making just a little bit, but they're profitable, that I can fund those people instead of the heavy hitters that, like, they come in and they make a huge gain and then the next week they blow the account, right? And then if I'm doing that, then I can build people up and I can build people up on size. And then, because you're trading size, you can make money on the commissions too. Right? Well, but going back to the thing, it seems to me that the prop firms are not popular because they provide the best deal to people or because this is the most effective thing for them to do, right? I think that the prop firms do well because everybody has this dream of, I'm going to quit my day job and just trade for a living. And the prop firm seems to be the most direct route to getting to that, to people. And I think that that's why they do it, is they're being sold on the dream that's frankly an illusion. Like hardly anybody does that. The vast, like all of these, because it's not easy to get funded, okay? But most of these people that get funded, they blow the account. I've seen a couple of these guys that like, you know, they kind of started doing this around the same time that I did. And for whatever reason, they're making YouTube videos or they're just posting a lot on Facebook and stuff like that. And there's some of these guys that they've literally been funded and blown the account a dozen times. Like, good grief. And nobody bats an eye at it and says like, maybe there's a problem with what you're doing here. Like, you know? So if that's the case, then that says to me that there should be room for you to create a funding firm that is actually better for the traders and more profitable at the same time. Right? Because if you can set things up in a way in which you're actually creating successful traders and you're increasing your size, then you're going to make more money from the trading in the end, right? Instead of you make it so hard to pass and you make all of the money from people failing the combine, which is what happens now, right? You've survived 19. That's really good. So there's another thing is like you can get funded and kind of like scale back a little bit once you get funded, right? Oh, you sent me a screen? No. That's way good. On a $50,000 like their standard combine? I don't know if he wants me to show the picture that he just sent me, but I am super impressed. That's a lot to have made from the trading. From that kind of, because he's basically like, well, I'm going to talk about it. You're basically making $2,000 a month. $2,000 a month on ES contracts. No, that's pretty, yeah. And you could be doing that with just even trading like one contract. Like one full ES contract. But... Oh, you're trading MES. But so how many lots do you trade on MES then? Four to five. Yeah, that sounds reasonable. You know, super volatile, only 3. So like one of the things that's kind of weird about the MES thing for me, because like we've talked about this before, I found it very difficult to trade ES, right? But I kind of stopped doing it in 2021, right? So like, was it 2021 or was it 2020? I can't recall now. But when these micro futures came along, I switched over to trading mostly those. So like this past year, you know, there's this past year where equities have just keep going up and up and up and up, right? So if I had been over here trading equities and I was just taking longs, you know, how well would I have done? Would I consider myself a god now because of how much I had made on ES or something? But the time where I felt like I struggled, it was a very different market, right? And then do you use the trade copier thing? I've had a bunch of people asking me about trade copying things, which are just like, ugh. I don't know how they work. So like when people are like complain about them, I'm like, I don't know. You're gonna have to. How you just have two instances and open it on both. Okay, so anyways, now that we've like way talked about that too much, let's read these couple of these stories here. Icon Enterprises shares crater 30% after slashing dividend by 50%. Any thoughts on why we are flushing on ES? I'm not sure. So let's read this story first, Alfredo, because it might give us some information, okay? Today's jobs report was a tale of two opposites. On one hand, the monthly payrolls change for July missed expectations of 200,000, and certainly the whisper number of 220,000, printing at 187,000, which would have been down from 200,000 and the lowest since December 2020. If only June wasn't also revised sharply lower to 185. Okay. Today's report was the second consecutive miss in a row for a series that until June had enjoyed 14 straight beats. You add in the 49,000 downward revision in payrolls for the previous 2 months, and the direction of travel here is clear. The labor market is softening. In keeping with the Biden administration's penchant of constantly fabricating data, both May and June numbers were revised sharply lower because, of course, May revised down by 25,000 and June was revised down by 24,000. Yep. Okay, just to show how ridiculous the data manipulation is, consider this chart. Every month's payroll in 2023 has been revised lower. Okay, well, I don't think that you have enough evidence to suggest that the Biden administration is somehow cooking the numbers, or that the Department of Labor is somehow cooking the numbers. But there's certainly something going on there that these guys should be looking into and fixing, right? And what the heck is going on with the estimates? How can the estimates be consistently wrong like that? Is a little weird. Anyways, as we continue. As if the rigging wasn't enough, the birth/death model laughably added 280,000, quote, jobs, the second biggest monthly increase of 2023. Okay, so putting the 187,000 gain in context, while effectively the smallest since 2020, it is still a historically strong figure for Fed's purposes. Economists estimate the U.S. needs fewer than 100,000 in net new jobs to account for increases in population. Looking at the 2018 to 2019 period, payroll gains average over 163 over those 2 years. But while the headline numbers were ugly, if still allowing the White House to claim victory for a 2K rebound from the downward revised June print, where the Fed will be scratching its head is the unemployment rate, which unexpectedly dropped back to 3.5% from 3.6%, and missing expectations of an unchanged print, meaning that the Fed's expectations for an unemployment rate spike to 4% by year end will have to be revised, or Powell will need to have to hike even more. The unemployment rate fell mainly because more job seekers found jobs rather than due to people leaving the labor force. While the jobless rate for blacks dipped to 5.8, that for Hispanics, 4.4%, rose, while whites, 3.1%, were unchanged. The labor force participation rate was 62.6 for the fifth consecutive month. The employment population ratio at 60.4% remained little changed in July. There was even more confusion in the wage numbers, with average hourly earnings coming in hotter than the 4.2 year-over-year expected at 4.4%, or unchanged from last month. On a monthly basis, the increase was spot 4% hotter than the spot 3 expected, and matching last month's increase. That said, one reason why hourly earnings went up is because hours worked went down to 34.3 hours, matching the lowest level since the spring of 2020 during the brunt of the COVID crisis. Just another sign of the job market softening. As Bloomberg economists put it, it is starting to look like both the all employees and the production and non-supervisory measures have been re-accelerating over the past several months. Here are some more. Do you want to read the other details? Among the unemployed, the number of persons on temporary layoff decreased by 175,000. The number of long-term unemployed was little changed at 1.2 million in July and accounted for 19.9% of all the unemployed persons. The number of persons employed part-time for economic reasons at 4 million changed little in July. These individuals who would have preferred full-time employment were working part-time because their hours had been reduced or they were unable to find full-time jobs. The number of persons not in the labor force who currently want a job was 5.2 million in July, little changed from the prior month. These individuals were not counted as unemployed because they were not actively looking for work during the 4 weeks preceding the survey or were unavailable to take a job. Among those not in the labor force who wanted a job, the number of persons marginally attached to the labor force was essentially unchanged at 1.4 million. These individuals wanted and were available for work and had looked for a job sometime in the prior 12 months but had not looked for work in the 4 weeks preceding the survey. Number of discouraged workers, a subset of the marginally attached who believed that no jobs were available to them, was little changed at 335,000 in July. That's actually a big number. On the household survey side, things were a little better with the number employed jumping to 68. This is the second month in a row the household survey showed better job gains than the establishment survey. Of special note, employment at full-service restaurants notched its first decline since January 2021. Overall, restaurant employment eked out a small increase, however, thanks to another strong month of hiring at quick-service restaurants. Okay, so commenting on the report, Florian Leppo of Lombard Adhere Asset Management was downbeat, noting the report is probably less positive than it looks at first sight. Half of the sectors reporting have now stopped hiring workers. This is the first month in 10 years showing that dynamic with so much clarity. Last month, 54% of sectors were hiring. In July, that number has fallen to 50%. In the end, this is not the kind of job report the Fed will be happy with. Job creations have normalized, not declined. Even worse, the unemployment rate has declined, not increased. Markets are likely to treat that kind of details with caution, and the volatility of rates is unlikely to fall back with that high a level of uncertainty. Dominic Konstam, head of microstrategy at Mizu Securities, was also on the glass half empty side. There's light at the end of the tunnel in terms of the eventual softening in the labor market, he said, pointing out that strength in payrolls was driven by construction and health education, and this sector is one of those that has struggled to get back to trend, so it is finally normalizing after COVID. Outside of those sectors, jobs would have been just 60K-ish. Bloomberg Economics' Anna Wong and Stuart Paul also had some cautious observations. July's surprisingly low non-farms payrolls and the downward revision to June's figure reinforce our view that cracks are emerging in the labor market. Firms cut workers' hours, something that has preceded large-scale layoffs in the past business cycles. More important for the Fed's thinking ahead of the September FOMC meeting will be wage growth. Average hourly earnings surprised on the upside, but due to reduced work hours, weekly earnings rose at a very subdued pace. All in all, this report bolsters the case for the Fed to pause in September. Man, there's so much here, but I'm going to finish reading it, okay? Others were more cheerful. Former Fed Governor and University of Chicago Professor Randall Krosner said that this is still a pretty strong report and adds that the hawks at the Fed will be focusing on the wage growth, and that will be the real concern for them. Echoing this, Bloomberg's Edna Karan writes that Powell is probably pointing to the wage numbers this morning as the reason why he has been continuing his hawkish warnings. His Jackson Hole speech this month is going to be very interesting. Steve Sosnick, chief strategist at Interactive Brokers, agreed, noting that this report is not one that will allow the Fed to get meaningfully more dovish. Sure, payrolls came in a little below estimates, plus downward revision, but 13K or 49K in a labor force of 150 million is not that meaningful, so that's a goodish. The baddish is the unemployment rate fell with the labor force participation holding steady, and month-over-month growth in wages was above estimate. Finally, Gregory Farinello, head of U.S. rates trading strategy for Amerivet Securities, says the jobs report is one data point and the Fed will continue to look at the totality of the data, but that does not spare the bond market from its recent weakness, with a subtle shift in tone as the front end is now leading the selling pressure. This report, unlike the downgrade narrative, is more specific to the economy and Fed policy, so a bit more sensitivity on the front end makes sense to us, which is exactly what happened. The 5-year moved up more. And now, with the jobs report in the rear mirror, Treasury supply is going to be the main driver of the rates market, particularly with new sales of 10 and 30 years next week. Long-dated Treasury yields are sharply lower in knee-jerk reaction to the jobs miss, but don't expect that status to hold. This turns our attention back to supply, says George Gonglaves, head of U.S. macro strategy at MUFG. The market will try to extract as much of a yield concession as possible to push the up coupon levels. The key will be post-auction price action next week versus the setup, though. A very astute observation there at the end. Very important for us. Glad that I read it all the way. So they're saying we've got the economic data out of the way, and now the only thing that we have to worry about is how much the Treasury is auctioning off. And so they're concerned that on the days that they are doing auctions, that we will see the yields rise. I don't know if you remember, Seth, but back when I was mainly a crude oil trader and then Corona happened, always want to trade 60. I remember they hate currency. Yeah. Well, I thought you were still trading oil. Oh, but I guess you are trading equities here. Yeah. Do you know much about... Oh, jeez, don't get me started on that thing, man. It's because, like, what the high COT and low COT means is, like, a really... This is something that I remember talking about and like studying a ton in the early days with John Bottomley. But I was never able to really find anything with it. And like what people say it is kind of like doesn't really make sense. So what it actually is it's, as my understanding is, like if you take like the highest of the cumulative delta in that bar and then you look at what it's come out to in the end and what the difference between those two are. So I don't... It's one of those things is like there's all these pieces of data that like there isn't really, once you get into order flow, especially because you're talking about like limit orders at each price, right? And all of those limit orders are constantly changing. The amount of ways that you can aggregate and analyze that data are like endless. But can you actually prove a real statistical behavior based on the market microstructure that will give you an advantage? I think that what happens is we put together a thing and put it out there and let people sort from it what they want. Like with my indicators, I don't come in and say, okay, here's the indicator, here's like the setup that you're looking for it and things like that. My indicator is set up for you to be able to display, basically in order to take the things that we're seeing here on the DOM and convert them into algorithmic trading. That was the purpose of those, right? So I'm more about being able to show you all the data and filter it flexibly, right? So that if you have a stylized behavior in the markets that you know about, you should be able to use my indicators to be able to make the strategy that you want, right? Bostic is speaking. You dumped out oil after good times and Corona times, really? Because, I mean, oil's been doing crazy stuff lately. Really should be, I don't know. Like, the thing is that it's just like the S&P 500 keeps going up, right? Like, at the end of the day, how much would you have made if you just put it all in an index fund? You know? Well, you made more than that. You made 24,000, so you probably made more than that. Now we got to get you to 5 years, and then we've got to start a fund. Right? Okay, so the other story here from Zero Hedge that I wanted to read here was rate hike expectations have slipped lower following the morning's disappointing payrolls print. September remains around a 20% chance of a rate hike, but the rest of the year has seen higher terminal rates dragged notably lower. The short end of the Treasury yield curve has tumbled, while the longer end is also seeing yield slide. The chart below offers context on the week's moves, which I've already shown you guys. As we warned, we could escalate very quickly here. What can possibly go wrong by shorting treasuries? And then he shows the picture. Hold on. What is the picture here? Can't see it. Open image in new tab. SIG today, CTA position estimates. Oh, I see. So it's basically they're showing that their models for CTA positions suggests that all of the CTAs were short going into this news. So that totally makes sense. So really what we're saying here is that we've probably developed a really strong informational inefficiency here today, right? So here, the dollar is fading on the dovish shift. That is sparking a bit under gold. So what it sounds to me like is happening is the treasuries are moving up a lot more than you would have thought, because the CTAs were so short and some of these other guys were short. We'll see if that extends into next week, but this could give us good locations to go short in the treasuries, because we've got auctions next week and stuff, right? Also, we get CPI next week, right? Yeah, you made another one with 24K? That's not bad. You'd have to go to the bigger, if you want to make 6 figures, though, you'd have to go to the bigger ones, huh? Yeah, it's so going back to the question, Alfredo asked, any thoughts on why we are flushing? It seems to me that when the news hit, there was a little bit of uncertainty, but that the market overall decided that this makes it easier for the Federal Reserve to hold rates where they are. And I think that because of the headline number, that's true. But I think that some of these forward concerns that people have about wages rising and inflationary pressures possibly coming in the future and a second round of inflation hitting in a few months, I think are still there. And so how much should the treasuries be moving on this move, which was like a fairly muted report. I think from fundamentally, we've probably moved too far. But because of all of the CTAs and everything else like that, the treasuries are just buy. But over here in the equities, the situation is different, right? In the equities, people have already kind of been buying all the time anyways. And it seems like it's just like not, it was not there. Maybe some people thought twice and said, well, this number is maybe not as good for the market as it appears at first glance. And so they retraced the move. And that's my theory on why the S&P 500 retraced while the treasuries continued to push highs. Oh, you're looking at the short volume on the individual stock. But what they're doing on that picture that I showed you is they're basically saying, okay, CTAs use momentum. So like, which percentage of the CTAs are likely to be long or short based on current information, right? And what they had was basically like 100%. 100% short, right? So okay, I am hearing some stuff from Federal Reserve speakers at the moment, like Goolsbee is speaking. I didn't see that on the calendar, so that's interesting. Look at that new high. 111 even. That's so funny. When I said, like, what if I said it's so dumb because like I might not know whether the flows are really going to be long or short in that situation, but I can kind of game out, okay, if they are going to be long, and like, what does that look like, right? So when I was giving all of the examples earlier, remember when I said, oh, what if from a fundamental perspective, I said we should be 111 evens, right? And I was just picking that price because I knew that was like the most significant price above us. Had no inkling, like that it was actually going to get to that location, but here we are. Yeah, since the July 20th, the shorts made a ton. Well, yeah, and they added a ton. Like I said, it was Ackman. Was it Ackman that was like, I'm short hedging it and everything? Like, he's getting burned hard now. Hard. Interestingly enough, the 10-year yield is still at 4.076. I thought that we would actually be back to 4 by now. So that's interesting to me. So now I kind of have to look at this and wonder, like, is it going to ever stop? This could be on something where they just have to keep going and unwind this whole thing. Yeah, because what's surprising about this move in the treasuries is that usually you'll get something like, okay, there's the up and the down, and then it picks the eventual direction and it goes up, right? And then what you will tend to see happen is the square root law will start to come in, get involved, and they'll find a spot and they'll just build out volume at that spot. And then, like, as this session goes on, you are like, oh, this is a buy or this is a sell, and then like it goes nowhere. And trading on Friday tends to be like incredibly frustrating, right? That's not what's happening today. It just keeps going. It just keeps going. In fact, remember we had that sim trade on, and what did we take it off at? We took it off at 110.20 half. We took it off all the way down here. So we lost. So we could have made almost a whole other 350 on that trade. I've never seen a number that high, never on TLT. Yeah. I was kind of wondering yesterday evening, I think it was, that it was like, well, this seems to me like a situation where rates could go substantially higher. Like they're kind of sitting on the edge. But does that not mean that if they don't go, that it's going to flip around on people, like just as everybody's getting really excited to go short? And that's what looks like is happening today. But now the question I have is, does this really have legs going into multiple days? Because if it's primarily short covering, I don't think it does. If it's primarily short covering, especially if, well, it depends on what happens next week, right? If CPI is bad, then we're just gonna retrace that non-farms, right? So the whole thing is just all crazy. Okay, so now that I've done all of that, I guess we can talk about prop firms again, because I know you guys love talking about that. No, you know what? The thing is it's Friday. We're supposed to talk about dating and society. Are we not supposed to talk about dating and society today? It's because it's a Friday? Except for that we don't have any man, it's a bit, he's been gone for a few weeks and I've already forgot his name. Whatever. I'm just not going to remember. Talk about the weekend. I should do. Well, I'm hoping that I'll be able to work on my desk this weekend. I think it's a little bit cooler than it was last weekend, but I've done a lot in the garage. I got these hanging garage things. I put tons of stuff up there. I have like 3 garage like shelves. And I at this point, I could probably get rid of at least one of them. And maybe even with some consolidation and so forth, 2 of them. But then the stuff that I do have on the shelves is mostly like tools and stuff. So if I get like some tool workbench cabinet sort of things, I can fit it all in that. But I don't think I'll buy one of those. I think I'll wait a few years to buy one of those. I don't know if I would actually use it. I think I should do what my wife was saying and just take things, turn it. There's this one where you can take them off and it just turns into a bench. So I'll do that. But I don't know if I'll do that this weekend. I think this weekend it'll be primarily the desk, and then if I have time or can't do the desk, then I will just study and write videos, because we do need to get that smart money concepts video out. Really want to do that one. I don't know if I have like the best script for it, but I really feel like the data and stuff that I have is significant, and it's a subject that people will be really interested in. And I'm hoping that when I put that one out, that I get a bunch of comments that might give me some ideas for the next videos. Because other than that, I think there's a piece of hardware that somebody wants me to review that is coming. And I will probably make a video when I have the desk and the computers all done to show you the newer setup. So that's 3 videos. But then after that, not sure which way I want to go. It might be me being. What might happen is me moving into describing how specific institutional strategies work, like how does a CTA work, and going into like a real deep dive of like how do you practically implement a CTA. That will require a lot of learning on my part though, right? Was AshK was the name that I was searching for. I haven't seen AshK in a while. Anyways, no, so on there is something to talk about in dating in society though, right? So the big thing everybody's talking about this week. Oh, actually, can I find it? Oh, look, I have it pulls up right there from Reddit. That's funny. Dun, 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 dun. Oh, come on. I hate it when they do that crap. I just want the images. Come on. That's just the hill. Is the hill the only place where we get this one from? I thought that on Reddit I saw the pictures just raw. Okay, so I guess I have to show you the hill article, okay? So the story that this comes from is from the Hill. Let's close this. Okay, so the chart that everybody's been talking about this week is they've been looking at the political identities of 12th grade boys and 12th grade girls, and the boys are becoming considerably more conservative than liberal. In fact, what you kind of see is a bunch of them becoming not liberal starting in 2016, and then once you get into 2020 and past, they turn conservative, which is kind of how I interpret that line. And then you come over here and you look at women, and you can see that women just continue to trend liberal more and more and more and more. So what's behind all of this? And of course, everybody has all of these different theories, right? So people on the left are like, oh, well, we're not teaching the boys well enough, and they're getting caught by the alt-right pipeline on YouTube and stuff, and getting caught in by Andrew Tate. So basically, it's all Andrew Tate's fault, right? And they don't sit and think, oh, well, that's the reason why men are becoming more conservative. And they don't sit down and think, well, maybe the reason that women are becoming more liberal is because they're being influenced by social media, right? How is that not, like, wouldn't that be the natural assumption then? I don't think that they would agree with that, right? So so how do you sort out what's actually happening? Well, I'm not sure you can sometimes. You'd need more data, and you'd need, to do surveys about, okay, why are you becoming more conservative or liberal, and try and sort those things out. But there is one heuristic that we can use that when we're going into social issues is an incredibly consistent way of figuring out what's going to happen that's extremely effective, that I would like to present here for you today. And that is Incentives predict people's behavior more than ideology, right? In other words, the reason that men are becoming more conservative is because liberal ideology is objectively bad for them, right? And it has nothing to do with what they think or how they're being influenced by people, but rather, because the millennials, I think the millennial guys, they kind of got fooled on it, right? The millennials, it was still kind of happening. People said that things would go this way, and now we're in our 30s and we're kind of realizing, oh, it's like this, and maybe you're already kind of a little entrenched in your politics, okay? But the kids, they've watched what's happened, and the boys, they know, yeah, the liberal world is bad for me. The current state of things, for in terms of relationships between men and women and marriage and so on and so forth, is just objectively tilted against young men. If you are a young man, it's hard for you, because the women go for like the top 20% of people on Tinder and whatnot, right? So first of all, you don't get any kind of attention whatsoever, right? It's a tough struggle. You're on your own and you're trying to build a living, and it's hard to make money for the young kids, right? And then if you do get married, there's a really high chance that you get divorced and that you get screwed in the divorce, right? And so men are turning around and realizing that the world that we have created over the last 50 years or so is not good for me, right? Now, I'm not saying that that's good or bad, or like what is the good thing or the bad, or what things should be. I'm just pointing out the incentive for men right now is to be conservative in your politics, right? And on the split side for the women, the incentive for the women is to be liberal, because the left is voting women all sorts of rights and goodies for them, right? And they want to push it so that the government will pay for your contraception and so forth. And because what the left offers for women is basically a world free of consequences, right? You can sleep around, you can do whatever you want, you can get married and divorced, and you're going to come out fine. You're women, right? So the incentive for women is vote left, and the incentive for men is vote right. Yeah. Now, this is a situation that I do not think can go on forever, right? I think that at some point, when because really what I think is going on here is the left has made some societal changes, and now certain people are realizing those societal changes are not good for me, right? As these guys realize that those changes are not good for me, it's going to change things for the women. And at some point, the women might say, this is not good for me either. That's what I think will happen. But I'm a conservative. Could happen the other way around, right? But isn't it an interesting dynamic? But the other funny thing is that we've been talking about this for like 2 years, haven't we? So the interesting thing is that the political establishment we're only just now getting like real hard data that like this is what's happening. It's not that kids are becoming more liberal, but actually the women are becoming more liberal, and that's why like the United States as a whole is trending more liberal, but now the younger men are trending more conservative to cancel it back out because the pendulum has swung too far away. And in order for the because there's always this thing that like, the Conservative Party is going to go away, etc., etc. And I'm always like, guess what? Things change. Like, it's a competitive marketplace out there. It's kind of hard for one party to get too far ahead. Well, I think that what happens is, this reverts because of this dynamic, essentially. Where are we at? No, we haven't really moved to. You're kind of starting to see that curve, that square root behavior. So maybe 111 is enough to keep us here. But no, what I was going to say is, I think that the left has a huge problem on their hands in the future if they don't switch around and say, oh, this doesn't work for everybody, does it? Because I really don't think that you can get too far by upsetting half the country. You know, that's why I'm kind of like, I don't really want Donald Trump to be the Republican nominee again. I wasn't against him before. No, like there's all these people when Donald Trump got elected the first time that were like never Trump. I was not that. I was just like, okay, he's obviously gonna win, so let's just roll with it and see what happens. Okay. Now that he's running again, you know, so I don't want to associate myself with the never Trumpers because I hate those people, but I really don't want him to be the nominee again because in order to get something done, you need to have more than 50%, right? And if you continue to cling to this sort of like dichotomy that splits the country in half, you're never going to go anywhere. The Republican Party needs to find things that can shift things in their favor to, you know, 55-60% majority on certain issues. And, you know, so it's the same thing on the left. But I think it's even more dangerous because, well, not dangerous, but, you know, like perilous for the party itself is if your party is basically based on a dichotomy between men and women. I don't think that one's going to last very long because probably what happens is the liberal women don't have kids and just become this group of old maids, and the young conservative men find the few conservative women that are left, and they're the ones that have the kids. And then all of the you raise another generation of conservative people, and you don't get another generation of liberal people. Right? You can't maintain that for very long from a party perspective. Am I wrong? None of you said anything, so that must mean that you 100% agree with what I'm saying and that you think that I am providing you with great and insight that you would not get anywhere else on the state of gender relations in America. Right. Anyways, where are we at on yield? 408. You know, as big as this move has been, you've got to remember that we started the week at 4%, right? That's a little crazy. E-mini came back up here. I don't know. The market is kind of starting to give me that we're done vibe now, yeah? You guys are kind of giving me that I'm done vibe now. Because it is Friday. It is Friday. Well, let's come back here and see if there's anything we missed going on out there. CNBC's Steve Leishman says the labor force participation rate has flatlined. We can't seem to get more people into the workforce. Jason Furman, overall, this report is mixed for the inflation outlook. Jobs hours cooling, unemployment rate neutral, wages heating. Tend to think the order I listed them above is roughly right for what signals matter, so I think this report is slightly favorable for inflation. What's Nick saying here? Average hourly earnings should get pushed up by a calendar shift just like in July of 2022, and then that undue strength should flip to a softer gain than otherwise next month. Oh, okay. Be curious. Nick Timrose, 16 minutes ago. The index of aggregate weekly payrolls for private sector workers, which combines hiring. We see we've been talking about combines too much today. Combines hiring, wages, and hours slowed in July due to a drop in hours. Oh, what's this? Okay, Goldman Flow Guru Fade the Green, and an unusually urgent note from Goldman Sachs Scott Rubner. The Flow Guru warns that things are changing fast and advises clients to, quote, fade the green. With yields tumbling, U.S. equity markets are bouncing in early trading, but Rubner warns that the market technical flow of funds have seen a significant deterioration heading into the worst 2-week liquid period of the year. This is a clean sleep of supply. We have CTA supply in 6 out of 6 of our forecasted models. Really? Oh, wow. Basically, when they look at if we moved up over the next week, down over the next week, up over the next month, or down over the next month, all of them are to sell. Volatility control strategies. We estimate that volatility control strategies are in the 99th percentile net length over the past 10 years. Probably nothing question mark. The 3-day change in gamma was the 6th largest reduction in our data sets. Okay, so because everybody's getting stopped out, right? Yeah, the dealers long 1.15 worth of gamma. Dealers get significantly shorter on the downside, around the same level that CTA supply could step in. Short covering demand is over. GS Prime largest short selling in a month from Vincent Lin. Overall bet was net sold for a second straight day. Interesting. Money market inflows reaccelerated this week. That is straight cash, homie. 21 billion worth of MMF were added this week, while outflows from stocks and bonds. This should continue in August. MMF funds an all-time high of 8.1 trillion. So that does not tell me much about what the treasuries are likely to do, although we can probably guess, but it does tell us that, you know, stocks are going to face some headwinds in the near future. Oh, geez. Some random spammer in Discord. That spammer sure picked a cute profile picture, though. Oh, like here it is on Reddit is the latest. Oh, I'm just a regular new person, but I'm just gonna randomly mention a specific YouTuber. Not actually affiliated with them. I'm just new. Yeah. What's this? 50% Fibonacci retracement into FVGs. What is an FVG? Oh, a fair value gap. Yes, gotcha. No, but then this person is like, oh, you'll get much further if you just learn auction market theory. Yes, well, but there's a problem with auction market theory too, unfortunately. Oh my gosh. Okay, so let me read this one. Okay. r/day trading. Why do most traders not make it? Question mark. This is a post meant to engage conversation and get a variety of perspectives. I'll start. Most traders fail because they have no edge. Bravo. Brilliant observation there. Okay, but why do most traders have no edge? That's the real question, right? What this means is you don't have a system that you can quantify works X% of the time. When you have a system, you will weed out all of the BS trades you were first getting into because your edge is clearly defined and you have a solid criteria, blah, blah, blah. Second reason I feel people get into trading for the result and not the process of becoming a consistently profitable trading. I went into mental trading with the mentality described in last reason 2. It wasn't until I forgot about the money and focused on the system. Then I started seeing results. Now an average win for me is almost as much as all the losing it did in the first year. What you'll realize is all those risks. Yeah, but you've only been doing it for 2 years, buddy. I'm not going to read the rest of this because it doesn't matter, but I don't think that that's why. Okay, so I think I won't write a post right now, but maybe after this stream I will. I think that the market is structured as such that the majority of traders must lose. However, the number of traders that we see lose is even higher than I would suspect just from the statistics. So there has to be something else going on here. And I think that the problem really originates from the fat-tailed nature of the markets. So the markets are fat-tailed, and that means that the sorts of things that you think you see, patterns that you think you see in the market and that you think are profitable, are not actually profitable when you trade them over a long period of time. Is just you don't have enough data to actually see that. You're going to need like 5 years worth of data, and most retail traders don't do that. So what happens is retail traders go in and they start having a little bit of success, even though they're not able to verify how fat tails affects their strategy. And so they have that little bit of success, and then they go out and they start telling people how they had that success, and everybody just believes them. When the reality is that they're spreading misinformation. So essentially, the fat-tailed nature of market creates a community that is dominated by misinformation more than you typically would have online. And that's why so many traders fail. So the good news about that is that if you rely on the empirical, you understand the fat-tailed nature of markets, you rely on the empirical evidence, and you have enough data to actually verify that what you're looking at is a real thing, even with the fat tails, right? Then there's a little bit more opportunity for you, because there's all of these other people out there that are doing dumb things, right? And have no edge. And so there's always enough noise out there for you to be able to execute and do what you need to do because of that. You just have to have an actual edge. You need to actually know something that's going to predict the flows. And that's hard. But it's a lot easier when you've got all of these people to execute against and so forth, right? This guy says it's because of the low barrier to entry, but then this guy contradicts it. I agree with him. I disagree with this guy. It's kind of like how everybody moved to California for the gold rush, even though California didn't have that much opportunity, right? Apparently, California did have a lot of gold. What's this guy? I read tons and traded for 2 years and never found a priority certain edge, and I suspect there is none. Each and every technical assertion about the future direction of a time series, so complex as a security stock, crypto, whatnot, can be countered with precision with an equally credible opposite assertion. These being said, there is this idea that one does not have to be right at all times, but say just 60%. This would also be huge on long term, and in my opinion, not possible by sheer technical analysis. All indicators are lagging, and those supposed to be leading are circular or just apparently leading. MA and EMAs do not add anything substantial. They're just ways to better see how impossible it is to see future moves. All algos employ a fundamental glitch, not a formal one. There is zero criteria for an opinion, exactly like in a random walk setup, and they either do it by split-second arbitrage or by simply having a shorter connection to the server for front running. There are also partial profitable setups which vanish as soon as more people find out and overuse them because the effect of a vicious self-reflection of the market. They self-render moot and non-actionable as soon as they are employed. Correct. The only branch I find profitable is options trading for a simple reason. Options are hard to grasp. Many people just click buttons and offer edge to more knowledgeable ones, but as soon as this edge will vanish, options will also become a doom machine for most. Okay, but there are people winning, yes. There will always be somebody winning, but not constantly. The wins distribute randomly, so no matter how many pencils were eaten at the trading desk that day, and the shorter time frame, the more random the outputs. Too long didn't read it. It is impossible to be a constantly profitable day trader based solely on technical analysis. There's always a fundamental, substantial real-world criterion for anybody who is long-term crusher. TA is a well-veiled lottery. I studied dozens of books, hundreds of videos, placed a gazillion day trades with mixed results. That's right, they're all mixed. Nobody is able to totally lose or win on purpose because TA in day trading is not a science. It is just a superstition based on ignorance and hope. Yes, sir, you're correct. Well, it is time for me to get going. The market is still about where it was. I mean, the S&P 500 looks positive, so I'm gonna say I think that the treasuries are probably done for the day, but we may see some further rises in the equities as we get into the close. I mean, that's a common thing that happens over there, right? So, so today, okay, thank you, Emir. So today, let's put today's title as Yields Retreat. Retreat on mild jobs data. Today was an interesting day. But anyways, yes, thank you guys for coming in. I do wish I had taken some trades today, but I didn't have the edge. This whole thing has been so crazy. I actually am glad that I didn't trade. You know, I think I did take the long. So if I had traded, I probably would have made money and felt good about myself. But I don't think I really had a substantial edge in this environment. That was a weird data release. The market reaction to that one was weird. I guess I probably could have, because I should have been able to say, hey, like a good number, there's too many shorts, you know? I should have been able to make that determination, but it just didn't cross my mind. So, okay, that's okay. And then, yeah, thank you for the donations, guys. I don't need the money, but I really appreciate it when you guys show your support. Have a good weekend, and I will see you on Monday. In the meantime, stay profitable.